Hey everyone, welcome. It is 6 a.m., half an hour before the market is going to open. Yesterday, we had some interesting action where we finally got a down day, but when we look at it from a daily perspective, it just doesn't look that bad. It really was just sideways movement. You can see that where we closed on the S&P was pretty much the same level as where we opened the previous day. So really nothing to get too excited about. Today in the pre-market, it does look like we are opening lower, but again, it's just at the lows of yesterday's, and we're not even at the EMA 8, even at the pre-market. So what we're going to be watching for is whether or not we come down and touch that EMA 8. If we fall a little bit through it, not going to matter too much, just like this. We fell through a little bit and just popped right back up. There's plenty of times in recent history where we touched that EMA 8, maybe fell through to the EMA 20, and it was just fine. So if we get that tiny reversion to the mean, I'm not even going to call it a pullback because it's just to the EMA 8, that's only 0.7%. That's not even, probably not even one ATR. This is 3.84 and our ATR is 4.62. So not even in one ATR movement. That's completely normal, completely what we would call random. And then if we go down to the EMA 20, then that's 2%, which is like 1.5 days movement. So what was it? 4 about 2 days movement. So just nothing to get excited about right now. There's nothing to be fearful. There's this uptrend is not broken yet. Doesn't mean that we can't keep on going down to the MA50 and beyond, and then it breaks. But it is too early to get excited about a potential downturn at the moment. If we, what we want to keep in mind is triple or quadruple witching today. There has been low volume in the markets for quite some time, and the combination of the two can make for some wild swings. So if we get an outside movement, again, we're not going to get too excited. We want to see the market under normal conditions, not under special conditions, not when the FOMC is announcing, not when we have quadruple witching, not when we have these volatile events that we know are coming, but we don't necessarily know what direction it's going to cause the markets to go. Those types of events, unless they are fundamental, what large fundamental changes, they're not really going to have a lasting effect on the market. So quadruple witching is not going to have a lasting effect on the market. The FOMC, depending on what they say, may or may not have a lasting effect. It depends on what type of action they take. So we're just not going to put too much credence in any movement that we see today, unless it's just huge on huge volume. So I don't think we're going to get that, but that's what we're going to be looking for. If we have huge volume and huge direction, then that becomes more meaningful. Otherwise, we're just going to ignore whatever comes today. Let's just take a quick look at our futures. Then we'll see what maybe what direction the market might go or what it might do. That's a lot less predictable because it is quadruple witching, but we'll treat it like it's a normal day and then see if quadruple witching messes around with that. So if we look at our futures, we are going to, we're looking that like we're down. NASDAQ just barely down, so flat. And the S&P 500 basically flat. This is less than 10 basis points. Right here, it's looking like maybe 9 basis points. And then the Dow also very, very flat. Very flat. It's basically zero. So no bias going in, at least so far this morning. This is a completely different picture than what we saw yesterday, where the NASDAQ was up and the Dow was flat. And then we saw that I was talking about how we had disharmony in the markets, and we had it for a very long time, and it had to resolve itself. Well, yesterday's action was a step towards resolving itself, but it wasn't complete resolution. So I don't necessarily think that it's going to resume today, but at some point, it should resolve itself. The SPY should come back down. It should start to look a little bit more like the RSP. And then the Dow Jones, needs to move upwards, and then the QQQ needs to move downwards. That's for a healthy market. That's for a market that is going to continue to move upwards. It doesn't mean that we're going to get that. And if we don't get it, it's going to be difficult for the market to continue to move upwards, at least for a extended period of time. It could move upwards temporarily. It can move upwards in a small increments, but a long sustained trend, we would need to see strength come back into the Dow Jones and blue chips. So that's what we'll be looking for today, and going, well, today less because of the quadruple witching, but in the near future, in the next week, we want to see strength in the Dow Jones. We want to see not necessarily a pullback, but at least a reversion to the mean in the QQQ. And there were certain sectors that we were looking at yesterday. So yesterday we identified XLP and financials. So let's take a look at financials. You can see that it's looking pretty good here, as long as it can get above this 41.75 level. We're at 41.46, so we're pretty close. But if we can get above there and stay above there, then it's looking very good for XLF. XLF is going to be an important indicator because it is very difficult for blue chips. It's very difficult for the more conservative sectors to do well when financials are not doing well. Financials, basically, they fund everything else. So we would expect the financials to do well before everything else, or at least at the same time as everything else. So XLF is an important bellwether sector. And if that starts to do well, then we have the potential for everything else to align and for us to get into a healthy bull market. If we look at XLP is really just chopping. It's not looking super positive. So maybe I remembered incorrectly and it was a different sector. I'll have to go back and watch yesterday's video and see what other sector we were looking at. Or I don't want to spend the time to look at it again right now. So if we look at our indices, we can see that we're opening lower. For the NASDAQ in particular, we're at this horizontal line of support. If we break through that, which seems pretty easy, we could come down to this 47.68-ish level, and then maybe down to this 46 level. And if we break 46, there was a little bit of a gap here, looks like. We could add this line right here. Yeah, there was a lot of consolidation there, and let's put that line right there. For us to believe in the continued strength of the market, hopefully we wouldn't break through two levels, but again, it is quadruple witching, and we could have some wild swings, so we're not going to get too excited. What we want to be careful of is bull and bear traps today. So this was a bear trap right there. This was a bear trap right here. You could call that a bear trap. Looks like there's a little mini level right here. I'll make that a thinner line because, oops, or not. It's not as important, but there is some support right there. So we want to just be careful. If we get these wild, sharp movements, don't get too excited, especially today, because there could be plenty of bull and bear traps today, swinging back and forth as people are trying to get out of their expiring options. So one thing that I was looking at, I actually noticed it on Wednesday, but it didn't when the day off, and it just didn't register. I don't know why it didn't register. I looked at it, I knew it was significant, but it didn't it just didn't sink in how significant. I don't know. I must have been asleep on vacation. I don't know. So we're making new highs. And our fear and greed index is down over here at fear, which is really interesting that we're making new highs, all-time highs, and our fear and greed index is down here. Why is there fear right here? Why at all-time highs? Why is there fear? That's definitely not the case when we looked at it over here or over here. Let's see what kind of history we get on this. 1 month ago, we were at greed. Well, there was, I guess, just a little more than a month ago, we were in those 80s. So to be down here in fear at all-time highs, that is an interesting turn, because how does the fear and greed index work? It is measuring these different, I think 7 different measures. 7 indicators. We have momentum, which is still indicating greed, price strength. So it's the number of 52-week highs versus the number of 52-week lows. They're saying that it's indicating extreme fear, meaning that we're a little bit above 0%. So there's a few new 52-week highs, but a few more 52-week highs. But this is very similar to what we were talking about yesterday, the number of advances versus declines. But for us to be at all-time highs and just a couple more 52-week highs versus lows, then that is not looking very good. Let's take a look at our own and see how that is holding up. 90-day, we could look at 90-day, but I should have 52-week. There we go, 52-week highs, 90. This is too complicated. Okay, 30. And then 52-week lows. Six. Both of them very low numbers. Very, like we saw in the fear and greed index. Yeah, there's more 52-week highs than 52-week lows, but there's a very low number of both of them. So that is, according to their indicator, is extreme fear. Price breadth is very low. What does that mean? That means what we were talking about in terms of what we talk about in terms of momentum, the number of stocks above their 50-week, 50-day MA or their 200-day MA versus the ones that are below. And we're just not seeing breadth across the sectors. So it's not very strong there. Put and call options, we look at that in terms of CPC. VIX is right here. VIX, not just normal levels now. If we are concerned about the market pulling back, then we can buy some VIX calls as a hedge. We'll maybe look at that if we have time this morning. And then safe haven demand. What is this? This is, is money moving out of stocks, excuse me, and going into things like cash, money market, bonds? They're talking about bonds specifically here. Stocks so they only measure bonds. So this is when I go and I look at movement like across the sectors. I say, is money just moving to a different sector, or is it moving to bonds? Is it moving to silver? Is it moving to gold? Is it moving to Bitcoin? Is it moving to cash? Is it moving to money markets? Is money actually leaving the stock market? And according to their measure, it is moving into bonds. So I guess they're saying, well, TLT is moving upwards, despite what we've been saying about the Fed and where rates are going. So maybe fear is offsetting the anticipated movement in interest rates, which is extremely short-sighted of anyone who's making that trade. But maybe that is why this has been high, even though the probabilities of this happening should be very, very low. 10% might make sense for September, but definitely not for July. And then we've got the junk bond demand. How much money is going into junk bonds, so not US Treasuries, but the very poorly rated corporate debt. That not the AAA stuff, not the AA stuff, not the single A stuff, but things that are going like B, double B, C. Then if we believe in markets, then people, or mostly fund managers, that there's not a lot of people who go to bonds, but fund managers believe in the strength of the market and the strength of the companies to be able to fulfill their promise on their bonds, even the junkier ones. So if we are feeling good, then we will chase higher yield that is in the junk bonds. Otherwise, we'll stick to US Treasuries, and there won't be a lot of demand there. And they're saying there's not a lot of demand for the junk bonds right now. So overall, fear, neutral, greed, extreme fear, extreme greed. For them, that balances out to fear. So these are good measures. As you can see, that we look at a lot of the same things. We do look at this. We do look at this. We do look at this. We do look at this, although less in the past year or so because it's been less telling. We do look at the VIX. We do look at movement between dollars, between stocks and non-stock assets. This is the only thing that they include that we don't look at a regular basis. So this, as long as they're measuring these things well, then this is a good indicator, and that we're here in fear when we're up here in all-time highs. Not here, sorry, over here, over here and over here at all-time highs. It's indicating that, and just another way of saying that we're on shaky ground. We've said that individually, as over the last almost every day, we pick apart almost all of these and we take a look at them and say, well, that's not looking good. That's not looking good. That's not looking good. That's not looking good. And then we say, okay, we need to be careful here. Well, they summarized it for us and said, we need to be careful here. So it's just another way of looking at it and just say, okay, we need to be careful here. It's not quite time to be what they say is fearful. It's time to be careful. We are neutral on the markets, but we are cautious about the future. So far, it still looks good. It still looks okay. We are looking for this to maybe come back and hit that EMA 8. If that fails and breaks, then the EMA 20. But if that fails and breaks, that's when we start to get a little bit more fearful. That's when we start to lean a little bit bearish. And then if we break that MA 50, then we'll start leaning bearish. And then if we break the MA 200, then we'll be in full bear. So for now, we're not even at the EMA 8 level. So there's no reason for us to take action yet. We're just watching. For now, we treat this market as a bull market, but I am on the cautious side. That's why we're saying neutral and not, if we looked at this, it would indicate that we should be bullish. We should at the very least be leaning bullish, but we're just neutral because of that, all of that potential that this is indicating. So we want to see if this pulls back. At the open right here, looks like we're just going to be flat for today. But if we pull back down to the EMA 8, we're going to watch very carefully. So 477 on the QQQ. I have too many lines here. Too many lines, but I guess I'll draw maybe red, so I know that's EMA 8 for today. And then I don't think we'll hit the EMA 20. That would be pretty wild, but I might as well draw it on there, 467. Okay, and we'll do the same thing for the S&P. We got 543 and 536. Okay. So you can see 536 is very far away. If we cross all the way down to 536, that is not good. Not good for the markets. But of course, this is two and a half segments. And we're still not going to get too excited. It definitely doesn't look good, but quadruple witching, volatility, we would be careful of a bear trap if we do actually make it to 536 today. So I think we have a pretty good picture. Again, we are neutral. We are cautious, but we're at all-time highs. We've got really strong trend still going right here. The only thing is that RSP just does not match. And many of the things that are indicated right here are in this picture right here. And this is not saying bearish, it's going sideways. And that's another reason why it is appropriate. We're not bearish, we're not bullish, we're just neutral. Not to say that RSP dictates our viewpoint, but our viewpoint is supported by the RSP. So we know what to look out for. We're not going to make any major decisions about where the market is going based on today because of quadruple witching. We're going to be aware that there is a lot of potential for swinging up and down. And for the most part, I'm going to be treating this like a spectator sport. I'm not going to be, if I wanted to day trade, I could, because there could be a lot of movement, but I prefer to have a more relaxed day today, given that there's probably not going to be a lot of directional institutional volume. There is not going to be position taking today. So the trends intraday are very likely not going to last beyond the day. They're very likely not going to last beyond a few minutes or an hour or two. So that is day trading material, but it's not definitely not swing trading. It's definitely not position holding and position taking. It's people taking advantage of the volatility caused by large institutions. What it is proprietary firms and day trading firms who have discretion over their money, trading the volatility and the wake caused by the giant whales, the giant institutions that are handling retirement funds, insurance funds, who have to take positions. And in the taking of their positions, they leave a wake and they cause waves. And there are other firms that are not as large, do not have as much money, but they are still institutions, then they still have significant money, and they're going to be riding those waves in the intraday. And so we need to be careful because there are sharks in the water. There are at what they do. There are supercomputers out there trading algorithmically with a significant amount of money, and they're just way overpowered. And so if we want to swim in those waters when there's these giant sharks and whales and these animals that live in the ocean are designed to live in there, when we're just a human and we are designed to live on land, we can do that, but we're taking a huge risk. It's better to just watch for today. So we'll see how the market unfolds this morning. But again, we're not going to put too much stock in any direction that it goes unless we break these significant levels with momentum and with volume. Other than that, we're just going to sit back and watch and enjoy the day. Today is Friday, so there is not going to be an after-market session. So I'll see you in the weekly market review if you have access to that. Otherwise, I will see you in the morning on Monday. So have a wonderful weekend if I don't see you. Otherwise, just have a wonderful day.